Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 442. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Mm-hmm.
Promised last week I was going to stop doing that, and as you can see, I am a liar.
Well, you know, old habits die hard.
They do. It's taken me a little while to get over the date thing that I used to do. In fact, I still kind of have that reflexive desire to throw out a date as we're entering into the beginning of the episode. So I'm trying. 13 years down, and it's taking a little bit to transition to a new life.
Yeah, it's the first week of October.
It is.
I don't know what the significance of that is, but
I
just wanted to state an obvious fact for everyone.
That is a truism. That means the fourth quarter has arrived.
Oh yeah.
There was a time when people we knew thought it was the best time of the year.
So the underwriters should just push through everything.
For me, it's the month that I start to take note of how much larger my forehead has grown.
Yeah.
From last year.
Someone's got a birthday coming up.
This is true. This is true.
Yeah. Well, anyway, so I'm sure people didn't come to hear us listen.
They didn't. No,
pontificate about the time of the next thing you know, we're going to be talking about weather and
birthdays was last week's episode, if memory serves correct. Not this week.
That's right. So, what are we talking about today?
We're talking about indexed universal life insurance today.
Again?
Hey, when it's a podcast about life insurance, there's really only three major subjects we can address.
That's true.
So that's how it breaks down.
Yep, that's one of three branches. We're going to the IUL branch today. But this is good because this is kind of case study-ish.
It is. And
people like real data. So,
well, the good news is we've been doing this for a long time.
Yeah.
That's also the bad news when I self-reflect at night. But
still doing this?
Yep. But
it's bad when you meet people you haven't, or you see people you haven't seen in a long time. They're like, "What are you up to these days?" And you tell them, and they're like, "You're still doing that?" I've never known anyone who sold life insurance for more than 6 months. Or inevitably, I get the, I did that for a while.
Yeah.
45 years ago.
Yep.
1 6-month period.
Then I found something I could sell that people actually wanted to buy. Yeah. But with time comes a whole lot of observational data.
True.
And one of the fascinating things about indexed universal life insurance is it is a product that I think loves observational data. Because there's that variability to what the earnings are going to be.
Yeah.
And so you get to go a lot of years or months and look at all of the different index segments and see how things have grown over time.
How right or wrong were our assumptions?
Yeah, right. And this time we were actually right.
Yeah.
But we were wrong.
Yeah.
But we were right in a good way and wrong in a good way. There you go.
There you go.
So we've talked about this particular indexed universal life insurance policy in the past. And we're going to keep talking about it as we look at it because it's been around for a while now. Yep. And we get to see what has actually unfolded in terms of index performance here. And there's really interesting observations made about it because it shows us in real time what some of the things that people are, let's say, nervous about regarding indexed universal life insurance.
That's fair. Yeah.
What actually happens regarding those things.
Yeah.
So there's kind of three broad areas I'll suggest as far as what we're going to talk about with this policy. They show us how returns or performance unfolds over time and how resilient it actually is. They show us that despite things going in the opposite direction of what we would consider favorable superficially, policy is done just fine. And they also, this particular policy really became of intense interest for me initially because it is an example of somebody doing the polar opposite of what they originally planned to do.
Right.
With the policy.
Yeah.
And shows us the survivability of the policy in that context.
Yeah, this is one of those things where everyone who buys an index universal life insurance policy, at least from us, I should add that caveat, is aware of the flexibility.
Yep.
I mean, flexible premium is in the official name of the product. So while we have, I would say, a fair number of clients who fund it exactly as planned, we also have a fair number of clients who decide to do something different.
Yep, we do.
For one reason or another. And the challenging part for us as agents always is when we run the final, I would call it the final illustration. Everything's been approved. They've been through underwriting. They've decided, at what funding level they're going to pay premiums on an annual basis or monthly basis, whichever it may be. We are designing the policy, the best version of the policy to fit within the parameters that they give us.
Yep.
And that's the best we can do as agents. That's all we can do to do our jobs well. And then it's sort of up to them to see that quote unquote commitment through.
Mm-hmm.
And many times they don't. Like I said, for all sorts of reasons that we have no idea because they don't ever tell us. And then some other people have completely legitimate, logical, job change, life change, things that happen.
Yep.
Understandable. But our concern as agents always is this still going to work out well for them? If they don't, if they don't follow through with the way it was originally designed based on the assumptions that they gave us, how well is this going to work out for them?
Right.
So that, to me, that's what makes this such an interesting case study.
Yep, it does. So we'll start with the details of the policy that was purchased.
To which everyone's going to go, you can't buy a policy like that. I'm like, well, you can't anymore.
This is true. This is true. But look, the evolution of indexed universal life insurance that has taken place, that puts us where we are today, even though you can't get these parameters, you can still get some good ones.
Yeah, I would say they're different, but some that are better than what you could get at the time.
Yep.
For sure.
So this particular policy had at issue a cap rate of 12%.
Yep.
And a floor of 2.
And that's on the S&P 500.
S&P 500
annual point to
1
point.
year, point to point. So 12% cap, 2% floor.
Yep.
Which 2% floors are gone these days for the most part. That 2% floor still exists on this and any other product that had one. 12% cap's not around anymore, but we'll get into that in a minute. So here's what we know from now 12 years of data, where this policy was paid monthly. So we have like a bunch of index segments that we can look at. And we get to see how often the policy hit the cap, hit the floor, and was in between, things like that. So the number of times over this past 12 years that the index was at or below the 2% floor was 18% of the time. The number of
pretty
times...
low, actually, when you...
Yeah.
I mean, I would have assumed more. If you'd asked me ahead of looking at this data, what do you think it would be? I would have been north of 20%, probably.
Okay. Now, the number of times that the index ended somewhere between like 2 and 7%. So like kind of that moderation zone where it doesn't really hit the cap, but it's certainly not at the floor. 12% of the time.
Well, I feel good about that because that proves us right.
Yeah.
We speculated, I guess you call it speculated. We were looking at data I don't even know how many years ago this was. A lot of years ago, 10 plus years ago. We were talking and we were looking at some numbers and we're going, it's interesting and we were just looking at annual, not monthly index, but just annual index buckets. We're like, if you just look at probabilities, these things are either at the floor or at the cap.
Yeah.
Most of the time. Yep. There's not a lot of in-between years.
Right. So the inference from all of this is that like a little less than a third of the time, the index performance is something below 7%.
Right.
at or below 7%.
Right.
Which means 70% of the time it's above that.
Right. That's pretty astounding.
Yeah. Yeah. Now, if you look at a chart of annualized S&P 500 movement, you'll see graphically this same concept unfolding.
Right.
Like there's not a lot of moderation year over year with the market. It's either up, usually somewhere in the double digits, or it's down somewhere near double digits.
Right.
Most of the time.
Mm-hmm.
So this policy, when we put it in force, all of the modeling that we did on index performance assumed that the average index credit each year would be 6%.
Right.
To date, so going all the way back to the very first index segment and coming to current date, the average index earnings on this policy is 7.37%.
That's pretty good.
That's also known as a lot higher than 6%.
Well, there were, I wish we could call back all those people that told us we were dumb for using 6% as a assumed rate. None of them are around anymore. I don't mean they're dead. They're not in the business anymore. But do you remember those? Because back then the defaults on most illustration software was 7.5% to 8.5%, something like that. I don't think I'm being hyperbolic in saying that.
Yeah. This particular product, 7.5, something like that, was its default index assumption.
And we always pulled everything to 6.
Mm-hmm.
And we did that. It wasn't arbitrary. I made it sound like we just decided 6 was the number. We were, again, looking at probabilities.
Yep.
We were looking at the distribution of returns and going, now, caveat, that 6% was based on cap rates at the time of 12%.
Yep.
With much lower cap rates, probabilities change.
Yeah. Yep. Now, to be fair, the 6% assumption was one based on what we thought would happen with the market given the cap rate, but there was also a contingency built into that for the reduction of cap rates.
Yeah.
To say, look, we don't know that they're going to stay where they are. And we don't want to be in a position where they go down and now we have to immediately start making revisions to our assumptions.
Right.
The current cap rate on this policy is 7.75%.
Mm-hmm.
So that's a good bit lower than it was when it started. That's
425 basis points lower.
Yeah.
More than a third.
Yeah. And there was a time when it was more like 40% down because it was 7% at one time.
Right.
So there you go. Index caps can go down and back up. We've said this forever.
Yep.
And
we still average 7.37%.
Yep. Now, look, there is a chance that one who wants to be wildly pessimistic about all of this would look at this and say, okay, yeah, but like there was a period of time when the cap rate on this policy was higher.
Sure.
So perhaps your 7.37% number is simply a benefit from years already gone and unlikely to return.
You stole my thoughts. That's exactly what I would say. Someone presented this to me.
Okay.
You would too, by the way.
Yeah.
You start poking holes in it.
Right. Now, here's the problem mathematically with that assumption. If we look at just the past 2 years of this policy, average index performance, 7.33%. If we go and take the prior 10, 7.37.
Right.
So they're right around one another.
Yeah.
Yes, it's true that the higher cap that was 12% at one time does help. Now, that 12% cap only lasted for like a year.
Right.
Because the immediately following year, the cap rate went down to like 11.25%, and then it came back up to 11.75%.
Right.
So, okay, those years were absolutely helping when it comes to a higher average index earning.
Mm-hmm.
I get it. But
it was also when the least amount of money was in the policy.
This is true. It's also very true. And let's not forget this trend that the cap rate is now rising.
Right.
like it was on a pretty continual decline for probably a 9-ish year period. But now we're on the way back up.
Right.
And there's a lot of things going on in broader economy that are conducive to increased cap rates.
Yep.
So there has been this pervasive attack on index universal life insurance, especially on the internet, among agents who think whole life insurance is God's gift to people who want to buy life insurance.
Yep.
And they like to make claims that insinuate that insurance companies will manipulate cap rates as a way to screw you out of money and protect them.
Right. That's how they make more money when they want to make more money.
But that whole idea is fundamentally flawed because it completely errs your misunderstanding of what the process of setting a cap rate is.
Mm-hmm.
Insurance companies that issue indexed universal life insurance make money on the expenses of the universal life policy. So when you get a ledger for an indexed universal life insurance policy and you go to the charges summary, where you see things like per 1,000 fee and cost of insurance and policy administration fee, that is where the income for the insurance company comes from.
Right.
The cap rate is completely trivial from the standpoint of profitability.
Yeah, because all that stuff is taken off the top. So
right. The cap rate, the earnings that you achieve in terms of cash value growth in your indexed universal life insurance policy does not influence the earnings of the insurance company.
Mm-hmm.
Not unless there's an asset management fee. Some policies have that. There's a charge against the cash value of the policy.
Mm-hmm.
But most don't. The profitability, the revenue generated from indexed universal life insurance is entirely derived from the fees that are deducted from the policy.
Right.
The index earnings are not something that the insurance company is on the hook for, because the index earnings are created by the option strategy they execute to create the interest payment to the policyholder.
Right.
If the market is up 15% and the cap rate is 8%, that does not mean the insurance company is walking away with the excess.
No.
That's not how option collars work.
They're executing collars that can pay out 8%. That's what it means.
Now, I don't really do a lot of collars, but I do make a lot of money with options.
Right.
And I can promise you, there are weeks that I made money. The market is up way more than I made. I don't get the excess.
Right. Yeah, that's kind of how that works.
That's just the deal.
Yeah.
I took money up front on a more guaranteed basis, and when the market rallies, oh well, I gave that up.
So let me ask you this. Aside from, we know that options volatility or lack thereof affects how much the insurance company can pay in terms of the what the cap rate is set at.
Yep.
That's a factor, right?
Yep.
But I want you to talk briefly about what's the other factor. So in other words, we saw these cap rates come down,
mm-hmm.
and that could be explained by, options pricing to some extent.
Yeah.
But then we saw it come back up. So
yeah.
At least I think I'll say almost all of the contracts that we manage for people have seen their cap rates come back up. I don't know if all of them have, but I'll say almost all. Not come back up to the level that they were necessarily, but they sort of bottomed out and then started to climb back up. What's the other big factor?
The other big factor is interest rates, bond yields specifically.
Okay. What's that got to do with anything?
So when you pay premium to the insurance company, they're going to take that money and they are primarily going to buy bonds.
Right.
And they're going to buy bonds so they can satisfy the guarantees that are associated with the contract.
Yep.
And what they can achieve income-wise from that investment in excess of the guarantee is the money they have to buy options.
Yep. So when rates go up, they get to use more of the money to buy options.
They do. Because they have...
It's pretty simple. People talk about
income.
it being complicated. It's like, not that complicated, really.
No.
The execution of it inside is probably a lot more complicated. But but the concept is not if you understand those basic relationships we're talking about, you've got a broad understanding of how this works.
Yep. And
it's not arbitrary, and it's not anybody in an insurance company deciding we're going to make more money by doing it this way.
No. There's some nuance, like you mentioned early. Volatility affects option pricing. Sure. Demand also affects option pricing. Yep. So when indexed universal life insurance was relatively new, and there weren't near as many insurance companies trying to use it as a strategy, option pricing was a bit more favorable on the S&P 500.
Yeah.
And as more companies entered the indexed annuity and indexed universal life insurance world, that created a bid up in price on options for the S&P 500.
Yep.
So that
now the spreads are not as wide.
Yeah. That then creates a situation where there's downward pressure on cap rates because the expense of buying options goes up.
Yep.
And
more players equals a more efficient market, which equals less opportunity to make big gains in ways that you were previously.
Yep. So that is, again, it seems like, oh, wow, this is complex. It's just one more layer.
Right.
Really. But it is what goes into the process of deciding what cap rates are going to be or how they're going to move.
Right.
And that would be the chief reason why we're not seeing cap rates come back up to some of the rates that they were at 10 or 15 years ago.
Sure.
Because there is so much more buying activity now than once existed. It also explains why a number of companies have sought to create products with index accounts that are not just solidly the S&P 500.
Right.
Because if they have other index options they can now use options against, that pricing is not as overbought.
Right.
As would be the S&P 500. And let's not also forget that the S&P 500 is an index on which people who like options are going to be actively engaged outside of the insurance industry.
Right.
It's a big index. It's an easy to understand index. It's usually regarded as a pretty comfortable index. So if you're going to be in the business of trading options, there's a chance S&P 500 is a major one on your radar.
Right.
So despite a very large reduction in cap rates here, we are still well ahead of the 6% target we originally set.
Yep.
Now, just as a thought experiment, I said, well, what would happen if we were to take these results and just assume that these past 12 years are going to repeat each other, or repeat themselves.
Mm-hmm.
So we end up with the next 12 years with the same market results, but let's assume that this 7.75% cap rate is going to be the cap rate for the next 12 years.
That's as good or bad as it ever gets.
Right. That should, in theory, drive the average index earning down.
Yeah.
And it does. It definitely does. It would bring the average index earning over that 12-year period down to 6.24%. So if we were to go the entire 24-year period, we'd have 6.37% being our actual average.
Right.
So that's not a surprising result because index cap goes down. We would expect the overall average to go down. The piece that I want to call your attention to is the fact that we're still well in excess of our 6% number.
Right.
Which means we now have a cap rate that has persisted at a level a third lower than it was at inception. And 24 years out, we're still well in excess of our 6% assumption.
Right.
Which means if we put these things together with a certain degree of care, we can be in a position where pretty substantial cap rate reductions can occur and we're still just fine.
Mm-hmm.
And if you're looking at this and thinking, well, 6% versus 6.37, that doesn't seem that far apart. Well, consider this. I'm not going to use 6 and 6.37 because that would be the net number. We got to think about expenses here. So let's use 5 and 5.37 instead. 5% on a $20,000 a year amount premium investment, whatever you want to call it, over a 24-year period is going to grow to like $934,000.
Mm-hmm.
5.37 on the same amount is going to grow to about $985,000.
Mm-hmm.
So you got like a $50,000 difference.
Right.
Over a 24-year period when you change those interest rate assumptions,
mm-hmm.
which is a pretty comfortable margin at the end of the day. And that's assuming a linear growth pattern that ignores the impact that a 7.75% index credit's going to have when you have $900 some odd thousand in cash.
Yeah, exactly.
And zero risk of this thing going negative in any year.
Right.
Because of the 2% floor. Now, we mentioned earlier that plans did not go as planned. This policy was started with much more optimistic assumptions about funding.
Right.
That did not materialize.
Right.
At all. The paid premium followed the plan for about a year, maybe 2, and then just disappeared. And there hasn't been a premium paid to this policy in a long time.
Mm-hmm.
And despite that, the growth of cash value is still well in excess of the expenses that are deducted annually.
And I want to say, I mean, this is the way this policy was funded is not in any way a methodology that we would recommend. In other words, if someone came to us and said, I want to buy an IUL policy and I'm only going to pay the premium for 2 years and this is how I want to do it. I'd be like, probably not. Wouldn't recommend doing that.
Right. Or at least we wouldn't recommend doing this.
Well, yeah, that's paying a monthly premium for 2 years. Yeah, no.
But despite that, it is alive. It has survived. It has grown.
Mm-hmm.
The actual expense of the policy relative to the growth of cash is, if I'm not mistaken, and I'm speaking slowly because I'm trying to get the actual statement from last year to pull up because this year's statement hasn't quite been generated yet. We are talking expenses that are, a quarter, less than a quarter of the cash value growth. What
the earnings were.
Yep.
Yeah. So there's no risk of lapse at this point.
No.
And that's what we would be concerned about this for those listening.
And look, this policy has more death benefit than it needs.
Right. Based on the funding level.
The correct way to approach this moving forward, if we want to preserve the cash, is a pretty substantial reduction in the death benefit.
Right.
The other option, because this is universal life insurance, is for the policyholder to say, "Wow, I got several $100,000 that I would like to move somewhere safe. Can I put it here?" The answer is yes.
Yep.
Because there's a lot of years that have not been paid. You can go back and make them up.
Cumulatively.
Yep.
That's a beautiful part of indexed universal life insurance.
Mm-hmm.
You could theoretically, I wouldn't recommend the way this has been done, but theoretically you could skip a couple of years if you needed to.
Yeah.
And then catch it all up in the third year, so to speak.
Yep. This policy has a huge capacity to accept money.
Yeah.
And 2% being your worst case scenario, 7.75% being your best case scenario, that's a pretty good place to store safe money.
Yeah. It's a nice trade-off.
Yep. So despite something that did not at all go as planned, we're not super worried about the survivability of this policy right now.
No.
The policyholder
something we'll have to watch is through time, obviously, but
it would be inadvisable to keep the death benefit where it is. The policyholder has options, though.
Yeah.
Take a reduction in the death benefit or reposition assets and put more money in here.
Right.
Both work.
Yep.
Just fine.
Mm-hmm.
And of course, it would be slightly remiss to skip the point that this policy existed at the same time as a lot of whole life policies that have not performed as well as we assumed because dividends have gone down.
Yeah.
And the conditions in terms of cap rates have been less favorable for this policy, but it has actually exceeded what we thought was going to happen.
Yeah.
So this has performed better, where whole life insurance has simply performed slightly worse, not monstrously worse.
But it is an interesting comparison, because I know this is something we've talked about a long time ago. And that was the fact that, I mean, cap rates in an IUL policy can come down, but they will tend to rebound much more quickly than dividend reductions in whole life insurance do.
Yeah. Yep.
And that's absolutely been the case in this cycle, so to speak, if you want to call it. Cap rates did come down. They came back up pretty quickly, or begin to. I keep saying they came back up as if they came back to where they were, but they began to rise much more quickly. Whole life insurance over the last, 2 years, I guess, has come up slightly.
Yep. And the increase in cap rates has been more meaningful.
Yeah.
With regard to the actual interest payment on indexed universal life insurance.
I would say this particular policy has not been, the move back up in cap rates has not been as substantial as what we've seen in some other policies. But you have to keep in mind this policy is a 2% floor. So that makes it a little bit of an anomaly.
That guarantee costs money.
Yeah.
And it is going to have an impact on the cap rate.
Yeah. That's some policies that either have a 0 guarantee or a 1% guarantee have moved more sharply back up.
The last point I want to make is around the time this policy was issued, I can remember a lot of conversations with people about indexed universal life insurance where they would state something like, well, I have sort of a pessimistic view on where the market's going to go.
Yeah.
And I don't think the market's going to do as well in the next 10 years as it did the past 10 years. Which is weird because it's like 2012 this conversation was going on. But in any event.
Turns out it's done way better. But yeah.
None of those predictions came true. The market rallied incredibly well. Mm-hmm. This policy did incredibly well.
Mm-hmm.
And so the pessimism about things that are perceived as safer, like whole life insurance, ended up being the less good option.
Right.
Whereas indexed universal life insurance did better than we thought.
Yeah.
It didn't do better than everyone thought, because the idiots out there assuming 8% are obviously making revisions to their assumptions. But that was dumb.
Let's be honest. Anyway. They're just hiding. They're not making revisions.
And none of this is to suggest that whole life insurance is bad. It's just to point out
not at all.
that indexed universal life insurance does have some resiliency to it that whole life insurance doesn't possess.
Mm-hmm.
And when we say whole life insurance has performed not as well, it's a minor revision down.
Sure.
It really is.
Mm-hmm.
So the resiliency side of indexed universal life insurance really is something to take note of.
Yep.
Especially when you approach this, again, with a certain amount of reasonableness about what the expectation should be.
Right.
But this is a policy also, I'll just mention, that was issued way before any of the regulation that came about that pretty substantially reduced assumptions in indexed universal life insurance interest rates when it comes to projecting values.
Yep.
So there was definitely a path to do it appropriately even before new rules came in place that stopped or, made some reductions to the optimism about where indexed universal life insurance was going to go.
Yep. All right.
Okay. That's it for today. I am Brandon Roberts.
And I am Brantley Whittle.
We will see you next week.